Hello everyone, welcome back. And it has only been a short while since silver looked like it was breaking down, gold started shaking out nervous hands, and the same people who ignored physical demand on the way up suddenly decided that one ugly stretch on the chart was the whole story. But when you step away from the screen and look at what is happening in the real world, a very different picture starts to appear. Today is Wednesday, May 6th, in New York. Comment below what day and date you're watching from. And if you value this work, subscribe and comment John AG. So in this video, I want to make sense of the silver story everyone is talking about, but carefully. Yes, China is buying. Yes, India changed parts of its lending system. Yes, the futures market is showing stress. And yes, treasuries are back in the conversation. But some of the loudest claims floating around right now are being stretched beyond what the public numbers show. And when a real story gets exaggerated, people can miss the real story. So jumping in, the most important thing is not that silver pulled back. Silver does that. It has always done that. This is a metal that can drift one week and drop hard the next. The real question is whether the physical market confirmed the weakness, or whether buyers use the weakness to take more metal. And based on recently published numbers, China's March silver imports were not just strong, they were unusually strong. Imports came in around the 800-ton area, up roughly 3/4 from the previous month, and the year-to-date total pushed a little above 1,500 tons. While the paper chart scared people, physical buyers in China stepped forward. Does that prove a secret master plan? No. It proves one thing that matters. Price weakness did not destroy demand. In China, it appears to have awakened it. And that is the first clue. Because silver is not just a coin shop metal anymore. It is money in the minds of many investors, but it is also an industrial input. It goes into electronics, solar cells, vehicles, medical equipment, defense systems, and applications most people ignore until supply gets tight. That is why silver behaves differently from gold. Gold is mostly a monetary and jewelry metal. Silver has one foot in money and one foot in factories. From recent market updates, the silver market is still expected to run another deficit this year, even if the deficit is not as wild as some bulls hoped. That gives us a more honest picture. The demand story is not straight up forever. Solar manufacturers are using less silver per panel. Some industrial users are substituting. High prices change behavior. But here's the catch. Even with that thriftiness, visible inventory has been drawn down for years. Industrial demand may cool, but that does not automatically mean the market is comfortable. A bathtub can drain more slowly and still keep draining. Now moving on to China's exports. This is where the story needs correcting. The claim that China is sending none of its silver to the world is too strong. The latest public export framework still allows a few dozen approved companies to export silver. So no, this is not a clean shutoff. But do not confuse not a shutoff with nothing changed. A market can tighten through licensing, priorities, domestic demand, higher premiums, and slower availability without a dramatic ban. That is how supply pressure often works. It is quiet first, then it becomes expensive. Then, suddenly, everyone acts surprised. And we may already be somewhere between quiet and expensive. Because China is not only a major silver consumer, it is also a major producer and refiner. And silver is often recovered as a byproduct from lead, zinc, copper, and gold operations. That means the supply response is slow. If silver doubles, a copper mine does not automatically become a silver mine. That is the part many traders miss. They look at price and assume supply will rush in. But with silver, supply often limps. And this brings us to sulfuric acid. China's move to restrict sulfuric acid exports matters because sulfuric acid is used in parts of copper production, especially leaching. Chile has relied heavily on imported acid, including from China. Recent reporting showed shipments to Chile collapsing in March, and that is not a small footnote. Do not overstate it. Not every copper mine shuts down because acid gets harder to source. But in acid-dependent regions, it can pressure costs, schedules, and operating decisions. Because silver is tied to base metal mining, copper stress can become silver stress later. Not immediately, not perfectly, but eventually it can matter. Now, before India, COMEX, and treasuries, let me ask you this. If price is weak, but major physical buyers are still showing up, do you trust only the chart, or do you trust the movement of metal? Drop your answer below. One group watches red candles and freezes. The other group asks who is buying into those red candles. And that brings us to India, because India's silver story is also being talked about in a way that needs precision. Starting this April, India's updated lending framework allows regulated lenders to accept certain silver items as collateral. The key word is certain. We are talking about silver ornaments, jewelry, and specific coins under limits. Regular bullion bars are not the same under the rule. That distinction matters. Because the bullish point is still real, just narrower. India has a deep cultural relationship with precious metals. Gold has the bigger financial role, but silver sits in households, rural savings, gifts, religious traditions, and small business liquidity. Giving parts of that silver a clearer path into formal credit does not mean every bar becomes bank money. But silver is being treated with more seriousness, and that is a change worth watching. Now let's talk about COMEX, because this is where people love turning complex market mechanics into movie scenes. You hear claims about huge deliveries, trucks leaving vaults, and someone secretly draining the system. It sounds exciting, but we need to separate delivery from withdrawal. A futures delivery often means a warehouse receipt changes hands. The metal can remain in the vault. It does not automatically mean forklifts, armored trucks, and a midnight escape. Warehouse stock reports matter, and delivery notices matter, but they are not the same thing. That does not mean COMEX stress is fake. It means the proof has to be cleaner. What I am watching is registered inventory, open interest, delivery demand, and whether metal keeps moving out after ownership changes. When those lines tighten together, the story becomes more than theater. Until then, be careful with anyone turning every delivery notice into a default countdown, because the real silver story is strong enough without adding fog. And speaking of fog, let's move to treasuries. A former Treasury Secretary recently warned that the United States should have an emergency plan ready in case demand for government debt cracks. That is serious. But a potential breakdown is not proof of a guaranteed breakdown tomorrow. This is the counterpoint people need to hear. Foreign and domestic buyers still own enormous amounts of U.S. debt. So when someone says nobody wants treasuries, that is not accurate. The better argument is that the buyer base is changing, fiscal math is heavier, and the market may demand more compensation from Washington. That is a different statement, and it is much harder to dismiss. And then there is the Cayman Islands story. Official data and newer research show Cayman-domiciled hedge funds are deeply involved in treasury holdings, especially through leveraged basis trades. But that does not prove a hidden central bank shell company. It shows hedge funds, leverage, repo funding, and treasury futures have become more important than most people realized. And that may actually be more concerning, not less. Because when a market depends on leveraged players to absorb supply, everything looks fine until volatility forces those players to reduce risk. Then, liquidity can vanish fast. We saw reminders during the repo shock and pandemic-era market chaos. Different moment, same lesson. Even the safest market can need help when everyone wants balance sheet at once. So what does this have to do with silver and gold? A lot. When trust in paper claims weakens, hard assets become more interesting. Not because they are magic, not because they never fall, but because they do not depend on someone else's promise the same way a bond, bank balance, or unallocated claim does. That is why central bank gold buying matters. That is why China's gold imports matter. That is why silver's industrial deficit matters. And that is why price pullbacks should not be judged only by the emotion of the day. According to the latest publicly available filings and market updates, China's gold imports also jumped in March, reaching the strongest level in about 2 years, while official gold reserves moved higher. We do not need mystery around that. Reserve managers have been diversifying for years because sanctions, deficits, and currency volatility changed how countries think about reserves. Gold is the cleanest reserve asset for that job. Silver is messier, smaller, more volatile, and more industrial. But that smaller size is exactly why physical tightness can matter so much. A little extra demand in gold is a headline. A little extra demand in silver can become a traffic jam. Now what about platinum? I do think platinum deserves attention, but not because it is the same as silver. It is not. Platinum is more industrial, more geographically concentrated, and more dependent on auto catalysts, chemical uses, jewelry demand, and the long-term hydrogen story. South Africa remains the center of gravity, which creates geopolitical and operational risk. For some investors, a small platinum position can make sense as a satellite, not as the core. Gold and silver still have the deeper monetary history. Platinum can move hard, but it can punish people who treat it like a guaranteed catch-up trade. Palladium is even trickier because demand is tied closely to gasoline auto catalysts, substitution, and shifting vehicle trends. So I would not lump all white metals together. Silver is not platinum. Platinum is not palladium. And palladium is definitely not a simple copy of either one. Now moving on to mining stocks, this is where the frustration is understandable. Metal prices can be strong while miners disappoint. That is not always manipulation. Sometimes it is fuel, labor, taxes, permitting, dilution, weak jurisdictions, or management teams that spin the upside before shareholders see it. So when people say miners have to explode because metal prices are high, I get it. But I still want to see margins, free cash flow, balance sheets, and discipline. A miner is not a metal bar. It is a business wrapped around geology, politics, equipment, and human decisions. And this is where interest rates come back into the conversation. A lot of people still think gold must fall if rates stay high. Recent history has challenged that. Gold can rise with higher yields if investors believe fiscal, inflation, currency, or geopolitical risk is bigger than the yield they are paid. The real question is whether rates compensate for the risk. That is why this market feels so strange. You can have high rates and still have gold demand. You can have silver volatility and still have physical accumulation. You can have treasury demand and still have treasury anxiety. And you can have a correction in metals that looks scary on the surface while the deeper supply story keeps tightening underneath. That is the part I want you to remember. Markets rarely ring a bell before the obvious move. They shake people out, punish over-leveraged traders, make early people look foolish, and then, when positioning is cleaner, the same story everyone ignored becomes mainstream. If you're successful, share your success story in the comments so others can stay motivated. Because many people watching are not trying to gamble. They are trying to stay calm, stay informed, and make better decisions before the crowd wakes up. So as we wrap things up, here is my view. The silver story is real, but it does not need fake certainty. China's import surge is real. India's collateral change is real, but narrower than advertised. China has not completely shut off exports, but the export environment is more controlled. COMEX data deserves attention, but delivery is not trucks leaving vaults. Treasury stress is worth watching, but potential crisis is not guaranteed collapse tomorrow. That balanced view may not be as dramatic, but it is much more useful. Because if silver is going higher over time, the reason will not be one viral rumor. It will be the slow collision of physical demand, constrained supply, industrial use, monetary distrust, and investors realizing paper promises and physical metal are not the same thing. And once that realization spreads, the market can change faster than most people are prepared for. So keep your eyes on physical flows, inventories, China, India, treasury funding, industrial demand, and mining margins. Most importantly, do not let volatility make your decisions for you. Because being early can feel uncomfortable, but being unprepared when the market finally reprices can feel much worse than wading through a messy pullback. If this helped you see the bigger picture, subscribe to stay with the next update, because this story is still moving. And remember, this is education and market commentary, not personal financial advice. I do not know your income, risk tolerance, debts, or goals. Use this as a starting point for your own research, not a command to buy or sell anything.